markets. Stock of the day, I thought we'd take a look at the Centuria Industrial REIT, posting a profit this financial year, with funds from operations seeing a 22% boost. In line with upgraded guidance, shareholders will receive an 18.2 cents a share dividend. The REIT's occupancy rate is sitting just shy of 99%, with an average WALE, that's weighted long-term leases, of 8 years. Centuria was anticipating like-for-like income growth in FY23 thanks to strong market conditions. Seeing modest gains this morning. It was down early on the announcement. Back up now. Henry, what do you think of the Centuria Industrial REIT?
Koshy, well, as you know, that's probably a little bit dull for my investment risk appetite, the whole REIT sector, and I don't really look at it too often. It's a very specialist sector. This is Australia's largest domestic pure play industrial real estate investment trust. We used to call them property trusts, and there were fund managers that basically their whole careers were switching between one to the other to just get that extra little bit of performance. This is a pretty solid company, to say the least. I mean, it's a market leader. Industrial property, 99%, let's face it, 98.8% of occupancy is pretty impressive. Don't seem to have been affected too much in the economic downturn. The problem that REITs have is as interest rates go up, that does tend to affect the cost that they borrow at. This is only 33% geared, so it's relatively lightly geared. But also the question is with property revaluations, because a lot of the growth in REITs is from property revaluations. Now we're talking about house prices falling 10, 15, 20%. Now I know that industrial property is somewhat different, but you would imagine that it's still going to come under a little bit of pressure with higher rates. So it's a hold, 6% yield, not fully franked, but it's guiding, etc., to 17 cents distribution for FY23. It's got great high quality assets. It ticks lots of boxes. It's just a bit dull, to be honest, Koshy. I'm surprised you picked this one for me, actually. We usually go for something a little more racier, but
a bit sexier.
Solid, strong, hold, but it's strong market rental growth, etc. Great occupancy, great management. It's just.
But portfolios have a foundation of strong, sort of boring.
Yeah, we can't be 20% brain chip or something like that, So.
In fact, Mark, on the 20th, the reason I picked it, Henry, is because on the 21st of July, Mark was on with David Lane from Ords. Both of them said it is the biggest and the best of the industrial REITs, was trading at that time at 10-15% discount, and both had it as a buy. So after it's reported, after it's reported, Mark, what do you think?
Yeah, look, it was up at 318 about 4 days ago. I think one of the Centuria office REITs reported poorly, so the others got hit in sympathy. Pulled back quite a bit. I absolutely stand by the buy, even at 295 here. They've got so based on forecasts, they're expecting there's going to be 3.5 million square metres of gross take up over the next sort of 4 or 5 years. There's only 1.3 million square metres available at the moment. Right. So they're expecting demand to remain high. This thing normally trades on a 10% premium to NTA. NTA is $4.24. So. Right. And where the share price is right now is where it was a year ago. So even if property comes back, in the last year they've had a 1.6% revaluation to the upside, which is definitely slowing, that's for sure. But I mean, the pullback in the industrial property prices is largely priced in at probably and some. Right. So this one's a staple of for clients. Just very very steady she goes, as Henry pointed out. We have to have a little bit of boring in our portfolios.
So it's at Henry, it's a 30% discount to its NTA.
Yeah.
All right. Okay. So I buy.
Well, somebody's taking a view there, certainly, because it had a big fall. It may well recover to its NTA, but there's certainly, I guess, some question marks, I guess, about the value of those tangible assets.
It's very light gearing. Their mandates, their mandate I think is tops out at 50% gearing. They're only at 33. Okay. Their average weighted debt maturity is 4.5 years. So we by that stage, according to some analysts, we might have a rate hike cycle and back down again. So who knows?
Okay. All right.